Running to the next Lucro Masterclass, Finance 101, Unlocking the Secrets of Business Success. I'm super excited to talk about this topic because it is a massive issue in our profession. I went to school to become chiropractors or doctors, physical therapists, whatever you are in the healthcare field, but you didn't understand how to run a business. You didn't understand how to be a proper entrepreneur. I've talked to many doctors who don't understand what profit are, who are running businesses at negative amounts. They're great at giving clinical care, but they don't know how to grow and scale their business and have more freedom and get to the next level. And it's a fundamental understanding of business, and Business 101 at the very core of that is Finance 101. So super excited to be diving into this topic with my partner, Adam Rundle, who has helped scale multiple businesses over $100 million, even one business now that's over $1 billion. So let's jump right into this, Adam.
Okay, yeah, thanks for joining us. What we're going to cover on this call is the power of accounting, how do you utilize accounting in your business to run better practices and better businesses, how to read your financial statements correctly and read that information correctly so that you can understand it, the key metrics that you need to be focusing on, and then most importantly, the action steps that you need to take. So we'll dive straight in. We're talking now about the power of accounting.
Absolutely. One of my favorite quotes is the world's most valuable resource is no longer oil, but data. No longer oil, but data. And accounting is the language of business. This is how we communicate. I always say with relationships, communication is key. With running a business, accounting is the language of communication. And so if you don't understand accounting, you don't understand how to communicate, how to scale and grow your business.
So there are three kind of types of accounting that I want to talk about. I want to talk about tax accounting, financial accounting, and management accounting. And what's really important here is to understand that you can take the same set of data points, same set of data, and you can produce many different types of outputs. And in the accounting world, these are the three primary outputs that exist in the accounting profession: tax, financial, and management accounting. So I want to give you a little bit of contextual awareness about it. Why? Because if we don't understand the purpose of why this report or the set of data is being generated, we're not going to utilize it correctly. And that's a big mistake a lot of people make, is they're taking a report that's been made for their taxes and they're trying to make a decision about something that's got zero to do with taxes. So we want to create clarity here, which is the most important thing. So tax accounting is the entire purpose of taking your financial information and producing a balance sheet and a profit and loss statement so that you can finalize your taxes. You got to follow the tax code, the tax rules, the tax regulations. You got to do certain things that are applicable, certain things that aren't not applicable, and you're trying to make sure that you file your taxes correctly and be as tax effective as humanly possible. The exact same financial information can be also prepared for financial accounting. Financial accounting is when we are focused on external use. Here we're thinking about banks or external stakeholders that need to understand what is happening in your business. You want to showcase to them how good your business is, the health of it, the performance of it. And here there is a set of principles that are very different to the tax principles that you need to apply in order to showcase that, so that they can be assured that this information is reliable. Here we're using GAAP principles or IFRS principles on how we treat certain different aspects of your business. And then the last one is management accounting, which I believe is fundamentally the single most important accounting function that you need to be fulfilling in your practice. Management accounting is about internal use. It's about you as a business owner figuring out what is going on in my business, what does that look like, what does it mean, and how can I utilize that to make decisions to drive my business forward. There are no rules. There's no tax code. There's no GAAP or IFRS or anything like, or GAAP or IFRS or anything like that. It's up to you to figure out how are you going to understand the performance of your business as best as possible. Why are there no rules? Because it doesn't mean anything to anyone else. It only means something to you. If you were Apple, for instance, you're not going to be using your tax return or your once a year annual financial statement that takes months and months and months and be audited by some of the biggest accounting firms in the world. You're not utilizing that information to make day-to-day decisions. You're utilizing customized reports that you've generated internally in order to figure out what is happening in your business. And what's really important is they're not mutually exclusive. What we believe here at Lucro is if you do management accounting correctly and you understand how to run your business and get that insight, you can generate financial and tax accounting reports that are really, really good and really, really helpful for those different providers. But the focal point, the initial point, is in management accounting.
Absolutely, Adam. You hit it spot on. Tax accounting, valuable, but one day a year you file taxes. Financial accounting, valuable every so often when maybe you apply for a loan. Management accounting, valuable all throughout the year at all times, but nobody does anything typically except tax accounting one day, or financial accounting occasionally, and almost no management accounting because they don't understand their numbers. They don't understand how to read financials like a pro. So that's what we're going to help you guys understand, not only understand the numbers, but actually how to take action with the numbers. Biggest concept I want people to know is that it's much simpler than you realize. Once you know a little bit about any topic, you realize it's not as complicated. You just didn't know what was going on, so you assumed complication, but it's much simpler than you realize.
So yeah, thanks for that. And what there are kind of three primary financial reports that are generated no matter what accounting you're doing. Predominantly when you're doing tax accounting, we're focusing on a balance sheet and a profit and loss statement. A cash flow statement's kind of irrelevant, no one really uses it. In financial accounting, all three are really important. In management accounting, all three are really important, but often they don't even look like that. They're just in some other format, some other way, they kind of mingle together. They're in a different way to give you a different picture. But if we understand the three key reports, we're going to start to get a base level understanding of that language that Warren Buffett talks about, of how to then kind of utilize that information. So the first one is our balance sheet. So the most important thing, a couple of important things that you really need to know about a balance sheet, less so than what the numbers tell you, is the balance sheet is a depiction of the health of your business. It's a snapshot, one point in time. So if you run a balance sheet, it's telling you on that particular day that you ran that balance sheet, or whatever day you chose to run the balance sheet, what is the health of your business on that day. And we determine health by looking at three key things. We first look at assets. Assets are things that we own, that belong to us or are due to us. We then look at liabilities, things that we owe other people or that we need to provide to other people. And the net result of those two is the equity value of your business. Simple example, if I had $100,000 in my bank account and I owed the bank $20,000, on that specific date in time, if I decided to wrap up my business, close up shop and just start all over again, or just sell out completely, I'll take my $100,000 out of the bank account, I'll give the bank $20,000, and I'll be left with $80,000 on the table in front of me. That is the ultimate value of my business. That is what a balance sheet is trying to tell you, is how much do you own, how much do you owe, and then what is the net result of that. So assets are broken up between things like bank accounts or any loans that people owe you. Could be physical things like your computers or your furniture or things like that that you actually have intangible, they have value. Yes, they may not, you may have already paid for them, but they actually have value. You can go resell them at any point in time. Your liabilities are things that you owe, credit cards, loans to other people, SBA loans, and then your equity is obviously the balancing act of that. And sometimes you may have already taken money out of the business. That's an owner's distribution. You may have already taken value out. You may put money back in, a contribution. The profitability of your business is starting to add value. So that's where we look at net income and retained earnings. But ultimately, we're trying to calculate how valuable is your business, what is the health of the business, and it's a single point in time. Okay, so that's what a balance sheet is. Then we look at a profit and loss statement. So a profit and loss statement is the measure of performance. And we're measuring the performance of your business over a period of time. Now you can choose the period of time that you want to measure. Generally, we're measuring it in monthly cycles or annual cycles, but you can decide I want to measure it a week or month or a quarter or a year, 2 years. And it's going to show us all the performance that happened over that period of time. And so what is performance? Performance is the day-to-day activities of your business. The things that are, you're selling products or services, or you're treating your patients, or you what your team costs, or your rent costs, all the day-to-day activities that you are incurring in order to run this business, ultimately to generate a profit. That's the idea. We want to track those. We want to see, okay, well, how much revenue did you generate? How much of that was cost of goods sold? How much of that went to rent or your team or your overheads or marketing, whatever it is? Ultimately trying to track that bottom number is, well, how efficient were you at the performance, at the running of your business? Therefore, how much money did you end up making over that period of time? Obviously, as you make money, what are you doing? You are building value. As you build that value, that will then be showcased on your balance sheet of that value that you've driven. Obviously, if you're running negative in performance, that's a decrease in value, and it will showcase on your balance sheet as well of whether you went down in value, up in value. And so that's the correlation between the two. The relationship between the two is performance is over a period of time. We generate value, then we see that on our balance sheet in that single point in time. At the end of that period, we say, oh, well, how valuable were we if we wrapped it up? Okay. And the last one is our cash flow statement. Now, this is really important. This statement, if you utilize this statement, no, I'm not going to say that. You don't utilize the statement. There are so few businesses that actually utilize this statement. This statement is all about reconciling or understanding movement of cash. You got to understand not everything is a cash transaction. If I was building a building and I went and I got a loan from the bank and then I paid all these different people, I may only sell the building like in 6 months' time. So there's transactions that are happening, or I may tell the builder, hey, go build it, but in 6 months' time, when I sell it, I'm going to pay you for building the building. So there could be all these little transactions that are happening that don't actually translate to people paying you money. You may sell a care plan and the person may have a payment plan, and in 4 months' time, they may pay you the last payment. So what are you recording in that moment of time? What's happening in that moment of time? So these transactions don't have a cash value. So what we're trying to do is we're trying to say, whoa, okay, you did all this performance, but how does that translate to actual cash in the bank? Why is cash important? Cash is the lifeblood of any business, so we want to track that. So here we start with how much, what was your profit? We adjust for that second line, which is adjusting for things that are not cash-based. We then adjust for things that are like investing activities. Oh, I took money out and I went and put it in an investment, or financing activities, I went to the bank and I got a loan, or I repaid a loan. That's money coming in and out of your bank. Ultimately, what we're trying to do is right at the bottom there say, how much money did you have in the beginning of the period? How much money did you have at the end of the period? I had 100 in the beginning of the period, I've got $165,000 now. How did I get there? Well, some of it was from profitability, some of it was from movement to banks on your balance sheet. We're trying to reconcile it. Now, the likelihood of using is very low. Practices are mainly cash driven. We're not on the accrual basis. You don't need to be on the accrual basis. So don't worry about it. Probably the single most important piece of information is just don't worry about this guy as much. If you need to worry about a cash flow statement, it's because you're probably not performing very well. So go back to your profit and loss statement, worry more on that, improve performance, improve efficiency, and usually the correlation is seen across the board because your performance increases and your cash increases.
Absolutely, and you hit it right on the head there, Adam. What metrics matter and what metrics don't matter? What things do you not need to know more about is highly, highly valuable, because oftentimes that can take up mental headspace, worrying about things that we think, oh, I don't understand this. How does that work? Should I get more information? But by understanding these simple things that we're talking about today, hopefully we can free up some of the headspace. And hey, don't even need to worry about. That's not something that needs to even be on your radar. You know enough information to know that it doesn't matter, right? Because as a business owner, there's 1,000 things you could do, but there's very, very few things that actually move the needle. And that's what we need to always be continually focused on. And so understanding numbers is the number one thing. Knowing which ones to focus on and what's going to drive success is what matters. 1% value in knowing the data, 99% value in knowing what to do with the data.
Okay, so this topic of in the metrics is now the next level. So okay, we've got this information, we understand management accounting, we've got it presented like this. Now we need to understand, well, what does this mean? What is this action? What is the story that these pieces of data points are actually telling us? And so that's where KPIs come in. And KPIs are key performance indicators, trying to identify, is this good or is this not good? All we're trying to answer is, if I'm looking at this number, am I looking at a good number or I'm looking at not such a good number? And I often use this analogy. If my son came home from a football game and he said, hey, Dad, we scored 30 points today. I'll be like, okay, great. How did the opposition do? And if the opposition scored 5 points, I'll be like, oh, well, that's amazing. That was great. But if the opposition scored 55 points, I'll be like, well, it's great to score 30, but maybe that wasn't that good. Okay, so the contextual awareness is important. That's what a KPI is. It's saying, okay, that's the number. I can't change the number. The number's a number. But what does it actually mean? And what we do here at Lucro is we've used a methodology called the perfect P&L, where we break down what should the number look like in your business if you are a high-performing chiropractic practice, healthcare practitioner out there in the space. What should your numbers look like? And we have hundreds and hundreds and hundreds and hundreds of data points of all of our clients, aggregated all of that to come up with these models to know what are the best performing practices doing, what do their metrics look like. Obviously, there are ranges. We can't give you just one number because everything, there's obviously always a range. But this is a very clear picture of what are the best performing practices doing out there in the market. Now, the last thing I want to say on the perfect P&L, because we have an entire video on this, so it'll be linked in this video. There's an entire video just breaking down the perfect P&L, how it works, how we analyze it, and I'm not going to bore you with that now. If you want to understand that, go and watch that video. It's going to have all those nitty-gritty pieces of information over there. The most important thing, though, is that we've got to understand that there are two major variables in the perfect P&L. The first is the level of monthly income. So depending on how much revenue you're generating per month, you'll have a different band. Why? Because businesses change over time. They morph. There's different allocations to different areas of your business. Certain areas get bigger, certain areas get smaller. That's normal. That's how business works. The second big piece is the way you generate revenue is very important. So if you're like very chiropractic heavy, where you're just doing treatments, your business will look a certain way. If you're more integrated medicine or neuropathy or selling big care plans, your business will look a different way. That's why there's ranges. Again, the perfect P&L will break that down in a lot of data and a lot more detail. This is just a little description of what's kind of in those different buckets. If you just want to see that again, that perfect P&L video goes into a lot more detail. But just telling us this is important, but where we put money is important for us. Remember, we don't care about taxes. We don't care about financial reporting. We're worried about management reporting. We're putting stuff in certain buckets so that we can understand what is happening. I don't care where your tax person wants to put it. I don't care where the bank wants to see it. I care where you understand, helping you understand what is actually happening in my business. What are the levers I can pull? Where the problem is so that I can improve it. That doesn't care about taxes, doesn't care about your bank. It worries about you getting clarity on what's happening every single day in your business.
Absolutely. Now we want to take that data and we want to do something with it. Like we talked about earlier, that is the number one value. You could get all the data in the world. I've talked to so many practitioners and doctors who collect data, who get daily report sheets, who have their CPAs do this, who have their team members do this. They collect all data and they say, what action steps are you taking as a result of it? And they don't have an answer. They aren't doing anything. Or their bookkeeping, they're getting their reports back and they have no idea what they're looking at, what actions to take of it. That is what matters at the end of the day, is what action should you take? And so that is our entire premise that we want to do, is we want to drive a stake in the ground and we say the gold is right below this stake. This is the fastest, shortest, easiest way to get to the gold. That's how you want to think about numbers and data. They're telling you where to go, what's going to take the least amount of work to have the greatest return, right? Because we want to get total profit of the business as high as possible. And what is the easiest, fastest way to do that with the least amount of work? Data will help to give us the answer to that question. You could dig 100 holes and never hit gold, or you could just hopefully hit gold occasionally, or you can know exactly where to dig, the least amount of work, effort, and fastest return with the highest percentage of accuracy, and that's exactly what we want to be able to deliver.
Okay, so when we're looking at trying to utilize this data, there's a four-step principle that we follow. The first is measuring the KPI and doing the analysis of figuring out what's the number. The second is to perform gap analysis. So before I get to the next one, the top two there, so KPI and gap analysis, these are financial things. This is part of the financial reporting. This is going, okay, I've used my perfect P&L. It's given me the foundation. I know whether this is a good or bad metric. I know whether this is in metric range, outside of metric range. I'm in the KPI that I want or I don't want. That's the first step. So that's why we started with the perfect P&L, because without those metrics, we can't do step two. Step two is starting to understand a little bit of conceptual awareness and gap analysis. Okay, well, what actually needs to happen here? Not the action I'm going to take on the ground, just financially. The first two are just financial. If the metric's not good, what needs to change? Oh, revenue needs to increase, or this cost needs to decrease, or something else needs to shift. Some financial thing needs to happen for this metric to be what we want it to be. Or if the metric is good, I want to go, well, why was it good? Okay, what was the reason that it was good? That's a positive reinforcement of a good metric. So the first two are centered around analyzing the data points. Now it gets to the meat. Now what do we do? And so once we know, okay, this metric is bad, it's not ideal, we understand what needs to change in it, we now can list the things that we can do, the actual physical actions that we can do in order to make that thing change. So this is now not financial anymore. Now we're leaving the screen, we're working away from our financial piece, and we're talking to the people around us, we're thinking internally, we're working with our team to actually create steps. Okay, we're spending, our overhead KPI is too high, it tells us we're spending $2,000 too much. Okay, I now know that, that's the first two steps, that's the 1%. The 99% comes in and says, okay, so what do I need to do? I need to go run a report of all my costs. I need to go sit with my office manager and get them to identify what are we using, what are we not using, and to come up with a list of costs that we can cut that are going to make no operational difference in my business. Then we're going to make those cuts, and then we're going to kind of see how that goes. That's acting strategically. Now we've actually built a set of tangible items that we can do to make that difference. But if I didn't know it was bad, if I didn't know I need to cut by 2,000, I could never get to that step. But the step is the most important. Then we move on to monitor and refine. So what do? We start the process all over again. We go back to our financials, we remeasure it over a period of time, obviously, so another month will go by or a couple of weeks go by, we remeasure it and we see, is our overhead KPI still out of whack? Okay, it's still bad, but it's better. Oh, look, we're only now $1,200 off, not $2,000. Okay, that worked. Oh, we need to do more. Or actually, it didn't work because we created this other, whatever it may be, and the cycle starts all over again, where you monitor and refine, and then start again. And consistency is the goal. Here's the goal, is that if you are only worried about tax accounting, you are going to do this process once a year. And you're going to do that process once a year on tax information that is not even relevant to how your business performs, it's trying to keep the IRS happy, probably delivered and analyzed by a tax CPA whose only interest is in filing your taxes and hopefully saving you money on taxes once a year. Or you could do that in a management reporting framework with reports that are designed and built purely for decision making, done every single month, giving you 12 iterations, so 12 times in the same cycle. So you compare yourself to the practice down the road. You did it 12 times with specific management reports that gave you the exact KPIs, the exact gap analysis, and insights and help on where to maybe go, and you did it 12 times. Who's going to move faster, quicker? Who's going to move faster? Who's going to move further? Definitely you. That's the entire purpose of how we then utilize the data into the cycle of analyze, gap analysis, act strategically, put those pieces in place, monitor and refine. Consistency is key. And so this is where, and well, not where, this is why, and I'll let Josiah talk about this some more, but this is why we built Lucro, because we realized this, that everyone is using the wrong set of data points to make decisions once a year. And we wanted to create a cycle built on management accounting so that you can have it twice a year with that exact cycle, every single time you get your report. And this is what we produced here at Lucro.
Absolutely spot on. You defined it. That's success is taking the correct actions with consistency. And so number one, you need to know what the correct actions are. And so with your monthly report, you're going to be able to know, hey, here's the actual, what happened. Here's my goal. Here's my forecast of what I wanted to happen. And then how does that cross compare to the perfect P&L to optimize for total profit? So you can get 20% of a watermelon, not 50% of a grape. Then once you have that feedback loop of actual data, forecasted or goal data, and perfect P&L data, then you can cross comparison and say, hey, this is where the gold is. This is where the stake in the ground occurs, that the gold is the closest, easiest to find. All right, in this scenario, let's say it is team, like Adam was talking about, or overhead. We need to now drill down into that specific area of our clinic and figure out how do we optimize this area? What are the next level KPIs that need to be tracked for this specific higher level area to then drill down? Do we look at trend analysis? Do we look at individual vendors? What exactly do we need to drill down to actually take the necessary action steps to get as much gold as possible? And then you just continue that loop. You go right back to the start every single month. What's the number one area I need to focus on? Here's where I'm at. Here's where I want to be. That's the gap analysis. What are the strategic actions that I could potentially take? Take those actions and then monitor again. Okay, did it improve? Did I get to the next level? And what do I need to do the next level? Do I need to focus on that same topic again for another month or another month? Do I need to focus on the same area for 6 months in a row? Or is it changing every single month and I need to focus on different things? But at the end of the day, if you want to get to your goal in the fastest way possible, you need to know what direction to go at all times. And if you don't have a financial compass and a feedback giving you those data insights, you're going to go in the wrong direction for an extended period of time. By the time you realize you're off track, it's going to take you way longer to get back to where you were. And then you have all sorts of headaches, time, money, freedom, burnout, turnover, all these issues that turn into tangible issues in your problem, in your business, if you don't understand the finance 101 of your business.
And that's it. That's what we do here at Lucro. And that's how we wrap up understanding finance. That's our financial 101. A quick little recap for you is, firstly, you got to understand what type of accounting are you looking at, and you need to be focusing on management accounting. That doesn't mean tax accounting is not important. It doesn't mean financial accounting is not important. Management accounting is where the gold is. That identifies where the gold is. The other ones are compliance driven to keep external people happy. Then we looked at how to read those reports, your balance sheet, your profit and loss statement, and your cash flow statement. How do they interact with each other? How do they relate to each other? And what you're trying to gather from them. We then broke down the key KPIs. So we're looking at perfect P&L. What are the KPIs that you want to follow? And then lastly, what is that cycle? What's that loop that you want to do every single month in order to improve the performance of your business. If you can put those pieces together, and we referred to a number of other videos in this call, you can go watch those videos. You go watch those videos and you get a little bit more depth, a little more understanding, and you get into that cycle 12 times a year, no matter what, driven by experts, signed by experts, given to you with key KPIs. You can almost guarantee that you'll improve the performance of your business. Why? Because the guy down the road is doing it once a year, maybe even once a year, on some tax information that is unhelpful and doesn't help him actually grow and scale his practice.
Absolutely. Take action, scale your business. Thanks for joining us today.
How long was it?
25.
It's good. That was good. I like that.
Yeah. I mean, I think it's